Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Chad here, your hosts on this weekend's edition, also your hosts throughout the week on our website, kereport.com, and podcast The KE Report. You can also check us out on some of our social media channels, and on YouTube, just search The KE Report. We're kicking off this weekend show with Mike Larson, editor-in-chief at MoneyShow. And Mike, just a broad comment here. We will get into individual sectors, but look, MoneyShow is really focused on a wide range of markets. You bring in a lot of traders, you bring in a lot of market commentators, and let them take the floor, share their thoughts with where they think markets are going and what will be the outperforming sectors. Can you summarize what you've been hearing from some of the guests you like? And also, in all fairness, your calls on the market, which have played the downside, the bear market a couple years ago, and that rebound bull market that we've seen. What are people at the MoneyShow most interested in?
Yeah, I think, in this market environment, I mean, it's interesting, these growth tech, that whole part of the market, it doesn't just have great stories to it, great narratives, things like AI and all the ways it can change business and consumer operations and things like that. It also happens to have market performance. If you want to find something that's catnip for investors, it's a great story and great performance. And that's what we've seen in tech overall, and then some subsectors of tech, sub areas like AI related stocks and so on. So clearly people are interested in that. They're making money in that, and they want to know how to make more money in that. That being said, I think that, there's something to be said for some of these sleepier sectors and people looking at this being a year where, yes, tech is still going to perform solidly, but there are other places that you're going to be able to make money. And I think some of the things that have not performed as well, but that could play catch up, let's call it things like financials, let's call it things like small caps. I think people want to look, for other alternatives. I mean, it's great making money in one sector that had a phenomenal 2023 and that will probably have a pretty solid 2024. But people are also looking elsewhere. And, I think one of the big stories out there is, hey, if this is a market where we dodge a recession, which is what the numbers seem to be suggesting, and not only that, we get the soft landing, which is something that, the Fed has tried to stick many, many times and probably hasn't effectively done so in about 30 years since the mid-1990s. If you get that scenario, then that is pretty darn bullish for small caps and other, sort of domestically growth levered type sectors. And by growth, I mean economic growth, not growth as in big tech growth. So long story short, I think that this is going to be a year again where people are generally optimistic, not wildly optimistic, but generally optimistic and want to know about some other things, maybe outside of tech, as much as they're still interested there. I would add that the crypto space, cryptocurrencies are, we're starting to get some nibbles and some interest there. That's been a sector that obviously has had so many sort of boom bust cycles over the last 5, 6, 7 years. But this time, with the sort of mainstreaming of the sector, all the money coming in, the new Bitcoin ETFs getting approval, and what that's likely to have an impact in terms of institutionalization of a sector that has, been at the fringes of the finance world, that has a lot of people excited. So I think that's another thing that people are interested in, and I think probably rationally so.
Well, Mike, let's tug on a few of those strings as far as these individual sectors outside of tech. Obviously, everybody can see the outperformance of tech over the last year or so and the excitement around AI, but you mentioned the small caps there, and I'm thinking back to the fourth quarter of last year where we saw the markets kind of bottom in October and then rip higher, and everything was ripping higher across the board. But some of those small caps in the Russell 2000 really took off, and now some of them have corrected down a little bit here just to start the year after quite a rally. Maybe they were getting a little bit overbought. But you had made the point of some research you looked at that showed other market cycles and how often the small caps underperform right before they really outperform. Maybe unpack that a little bit further for listeners here.
Yeah, sure. I mean, there's some great data. I think it was Charlie Biello who put it together. I follow him on Twitter or X or whatever we're calling it these days. But some of the work being done there, and it sort of put to bed the narrative that, well, you can't have a lasting market rally if small caps, if it's not a little broader, if some of those stocks being left behind don't participate. He looked at some of the data, and I think it was pretty convincing. And the narrative kind of shifted to, well, you can have that where big cap and big tech or big cap is running and some other stocks are being left behind. But typically, that condition is solved by other stocks playing catch up, and not just catch up, but overtaking the big runners. So, in other words, you can is a glass half full or glass half empty when you look at a market that doesn't have as much participation as you want. His argument was again that you're going to see this situation resolved not by like big tech crashing and small cap continuing to dramatically underperform, but rather big tech and the big cap part of the market doing okay, but the small cap side of the market picking up the baton and running, particularly over the course of the next 12 to sort of 15 months. And I think that sounds pretty valid to me. I mean, when I think about sort of conceptually what type of environment is great for, again, domestic growth, sort of your smaller mid cap type names, it's a situation where everybody's priced for a recession or a hard landing. You don't get it. So then you get some more of the growth component there that, hey, maybe these guys are going to be tied to a little bit of a rebound in the economy, or at least just a softening and stabilization versus a recession. And oh, by the way, now you don't have the interest rate situation hanging over them. And some of the other things that were holding back the sector, particularly financials being a kind of a key component in the smaller cap or mid cap space. You remove these worries about this mass wave of bank failures, which is obviously what we were all dealing with a year ago at this time. You remove that, and then, hey, what kind of environment is it? It's pretty bullish. So I think that's what you're going to see. Is you're going to see some rotation. You're going to see some broadening out. You're going to see a market that, we did run in small caps in November and December. We corrected in the back half of December and most of this month, but I think we're starting to kind of tentatively find our feet there again. And I think that's a pretty attractive part of the market for this year. So I think that after avoiding that or people staying away from that sector, it's going to behoove you to start paying more attention and getting more into small and mids this year.
Mike, what do you take away from some of these market commentators, some of which that look simply just at markets, a wide range of markets and how they are moving, sometimes individually, sometimes in relation to each other, and then these other market commentators that try to be economists and dissect every different economic data point that come out and then carry that into the markets to make their market calls? What do you think truly drives markets?
Look, I think it's a mix of sentiment. It's a mix of positioning. It's a mix of economics. It's a mix of the cost of money. And, on almost every front, things just don't look all that bad to me. I mean, on the cost of money front, the Fed is going to be cutting this year. You can argue about whether it's going to be 3, 4, 5, 6. I mean, the markets are all over the place sort of trading that scenario. But we're certainly not in a situation where the Fed's going to be hiking rates, and they're probably not even just going to be sitting on them. So from a monetary standpoint, you've got a tailwind. From an economic standpoint, let's be honest, this is waiting for this recession. It's like you've got to, you're like Rip Van Winkle. You could probably fall asleep against a tree and wake up in 100 years and still be looking for it. The recession hasn't come. If we made it through the bank failures, if we made it through basically this cycle's dot-com bust, which we had a couple years ago with all the SPACs blowing up and all the profitless tech companies going bankrupt and so on, we made it through that and we don't have a recession. You've got that going for you from an economic standpoint. You do have, again, from a sentiment standpoint, even now, I don't see indicators suggesting that we're wildly bullish. And it's not just the people on X or on the internet that will never be bullish till, kingdom come, but it's also just from a positioning standpoint. I mean, the data is leaning bullish, but it certainly doesn't look toppy. It certainly doesn't look like the wild, crazy exuberance you see at the end of 1999 or anything like that. So from a sentiment standpoint, I think you still have a kind of a decent bullish tailwind. So, I mean, you throw together sentiment, economics, cost of money, all that, policy basis, it looks like a pretty bullish environment. I mean, who knows what's going to happen with the election? There's still some other things that can happen. There's geopolitics. I mean, God forbid what's happening in the Middle East spreads and so on and so forth. Taiwan and China getting into a shooting war, whatever. But outside of those things, I think, it's a pretty constructive environment. So I would say, my advice for investors is don't go looking for a, horribly negative story when there just isn't one. I don't think that's being Pollyanna-ish or whatever. I think it's just being rational. There's times, and you guys, I've been talking to you guys for a long, long time. There's times when I am really pretty bearish, but I just don't see a reason to be now, and I haven't seen one for the last year.
Yeah, some great points there, Mike. And some people are just defaulted to always being uber bearish or uber bullish on either side of the equation. But one thing that has a lot of people's attention over the last year has been the movement of so much money into money markets on the sidelines, because for the first time in over a decade, people could actually make some yield on their money in a safer money market or CD or some kind of a vehicle without so much risk to the markets. And a lot of people patted themselves on the back the second half of last year for doing that and making 4 or 5%, maybe even 5.5% on their money. But then they watched the markets take off and do double-digit gains in the fourth quarter and maybe didn't feel as great about that decision. If we do start seeing the Fed cut rates and if we see interest rates continue to pull back down, then some of those yields maybe won't be as attractive as they were last year. Do you think that that means some of that money comes back in and starts speculating again in the markets?
Yeah, I mean, I think anytime you lower the cost of money and you lower the risk-free rate, the yield that people are picking up on just sort of their spare cash, I mean, you are going to be looking, it is going to drive some subset of the money that's parked basically to look for a home that's going to treat it better. We're not, and I would say we're not going to be in that sort of Tina, ZERP, NERP, everything's negative. So gosh, I have to chase every lousy garbage stock out there to find some yield in return, which is what helped fuel the SPAC and profitless.com bubble. We're not in that environment. We're in an environment where yields are probably going to come down. They're not going to collapse. So again, I would argue that that's modestly bullish. That's a environment where some money is going to look for a better home, but you don't have to be, a 90-year-old retiree who goes, only has a couple of years left that's going to throw all their money into SPACs because they're earning 0 or negative returns. That's crazy. That's ridiculous. You don't want that. But an environment where rates might come down from 5-ish% gently to 4-ish% or maybe the high or mid threes is going to create modest fuel for markets. And I think, again, that's probably bullish.
All right, let's get into a couple of specific markets. The first one being Bitcoin. Look, we recently had some Bitcoin ETF approvals. You even mentioned how still the environment at some money shows is simply that people are seemingly still very interested in the crypto space. However, ETFs were approved. Bitcoin has gone down since. What's your outlook on Bitcoin now that ETFs are in the mix?
Sure. I think what you're going to see and what you already are seeing is an institutionalizing to a degree of a market that's lived on sort of the fringes of the financial markets world, right? I mean, when Bitcoin first came out, there's probably 5 or 10 people standing around talking about it. And if you asked your average retiree on the street, what was Bitcoin? They'd look at you like that you were crazy, 10, 15 years ago. More recently, you've had this sort of boom bust cycle. We've had, still a lot of individual speculation, lack of sort of structure and institutionalization in the market. So you've had these wild, quadrupling, quintupling of markets, then 80% plunges and so on and so forth. But now with ETFs getting involved, with futures being involved, with more, advisors and family offices and, endowments and things like that will say, okay, this is a burgeoning asset class that is not going to take 20% of somebody's money, but 1%, 2, 3, 4, who knows exactly what it's going to be. You're gradually going to see money move into this market, and you're going to see more stabilization and more acceptance because I think it's too big of a trend to go away. I think there are some use cases out there. Yeah, I kind of look at it as, just like the housing sector in the mid-2000s, which got wildly overinflated, huge boom, huge crash. A lot of builders went bankrupt, mortgage lenders went bankrupt, people lost billions, blah, blah, blah. But out of that wipeout, there were a couple of companies that survived. There were some rational lenders that survived. People gradually started getting back into houses because they made sense in terms of buying a house versus renting, or price of a house multiple to income, things like that. So the industry ultimately came out of that. Same thing with the dot-coms. Why is Amazon such a Goliath today? Because it survived the boom bust in that market, even as many of its competitors got wiped out. So I sort of look at crypto as being the same thing. It had a gigantic, enormous bubble, a huge, gigantic crash, and all these people going to jail, and all these bad actors getting shoved out, and companies going broke, and so on. But you're left with an asset class that does serve some purpose. Investors that are going to step in if they know that there's some guardrails around this market, and that's what I think you're seeing. So I think that's why, again, boom bust, and then you pick through the ashes and see what's left. That's where I think we are in the crypto space, and that's why I think people are starting to pay attention again.
Well, Mike, I know you also follow the precious metal sector, and a lot of our listeners do as well. When you look at gold, really since before U.S. Thanksgiving last year, and since then, it's been waffling around either side of 2,000, but mostly held above it now for, November, December into January. Not a lot of life in the gold stocks, though. Those are still kind of in the hurt locker, but a lot of people are waiting for the proverbial breakout in gold. Do you see that happening in 2024? Do you see us waffling sideways here and limbo forever, or is there risk of a pullback in the precious metal sector?
No, I mean, I think, we've gotten up, we've tagged that breakout level. And unlike in past times where we've quickly kind of failed, right now we seem to be consolidating rather than failing. So I'm pretty optimistic there. I mean, admittedly, this is kind of somebody who's been pretty optimistic for a while and it hasn't panned out to a true breakout. But I think I'm pretty optimistic there. I think that there's a lot of things that argue for gold beyond just technicals. I mean, you've got monetary policy, you've got people looking for other things that, in a environment where the dollar is not going up every month like it did last year for most of the year and so on, things that argue for strength there. So, I think I think it's still an area you want to lean bullishly. I mean, obviously, it'd be great for people who've been patient to get that breakout. It's hard to say, don't worry, this time it's really going to happen. But I think, okay, I'm going to say it, this time it's really going to happen. So there you have it. I think that, again, because you've got some tailwinds in the form of policy, you've got some tailwinds in the form of the cost of money, currency, and so on that argue for a better environment. So patience is annoying sometimes, but sometimes it's also the best choice as an investor.
So then does that gold price breakout finally drive the stocks, carry the stocks with it?
Yeah, I mean, I think it has to, right? I mean, anytime you're a commodity or metals producer and your underlying market does well, it arguably should be bullish for the sector overall. I mean, there's going to be bad players. There's going to be companies that get caught. There's going to be companies that, have operational issues and so on that are going to cause problems. But I mean, in a bullish macro backdrop kind of environment, ultimately it's good for the sector. So yeah, I would think that you're going to see better times ahead.
Well, Mike, what about the energy space? Oil and nat gas are always a wild ride. 2022, they were a breakout story. 2023, they were a pullback story. How's 2024 setting up for the energy space?
Yeah, it's interesting. I actually just had a conversation with a guy who's a pretty big analyst in that sector. We're going to be releasing the episode soon. And his take was he kind of talked about the clean energy transition, how it's more of an evolution versus revolution, how there's going to be a lot of demand for traditional oil and gas and need for things like what the oil services companies are doing, especially internationally for a long, long time. Kind of talked about the idea of going from, much of the world that still has sort of needs to go to an energy abundant environment from being sort of energy strapped. So all of that adds up to a generally bullish long-term thesis. So, I think that, again, that sector had a great 2022. 2023 wasn't anything impressive. I would call myself as modestly bullish there, and I think that's probably a good stance for investors to have too.
What about copper then too? Because boy, oh boy, I hear a lot of bullish comments about copper, the supply demand imbalance, why copper needs to be much higher just for new builds to happen. But copper also does tie into the economy, and with a bit of a better outlook for the economy, even though a lot of people still waiting for that recession, is this year the year that copper finally has its day to shine and truly break out?
Again, maybe modestly bullish. I think the problem with a lot of the base metals is that money that's not sort of sector focused, specific, is going to look at it as just a China play, right? And they're going to look at Chinese headlines and they're going to say Chinese economy still stinks. The Chinese stock market's at a 5-year low. They're having to throw hundreds of billions of dollars more at their real estate and stock market because of all the issues they're having there with lenders going broke and nobody wanting to build these, buy these ghost cities and so on. And that's just my issue with some of they're just sort of, whether it's proper or not, that is kind of the perception. And when perception rules, sometimes actual money follows. And I think that's why some of those base metals are just going to have a hard time getting much momentum. Even if the U.S. economy were to do very well, you'd need to see it drag China up. And I just don't think that's what we're seeing right now.
Well, Mike, if we widen the scope out internationally, any other markets outside of the U.S. markets that have your attention as potential areas for investors to look at?
Yeah, again, I think so much of the, especially, the Asian sphere and a lot of South America that exports to China and so on is tied to that. There's concerns about the geopolitics there. So I think that you can make a case that some of these markets are undervalued, but they're undervalued for good reasons. I'd like to see just some sort of geopolitical detente with China. I'd like to see some, indications that they're getting a handle on their economic issues. They're maybe going to do a bigger stimulus or something. It would take something like that to really get me to look more at developing and emerging markets. I'd be more inclined to lean towards some of the developed markets, if I'm look overseas, places like Europe and so on. that I think can, kind of get dragged up by U.S. strength and maybe just it's a stalemate situation. We worry less about what's happening in Eastern Europe. That would probably be good for those areas. So that's where I'd focus personally.
All right, Mike, we've covered a lot of different sectors. Thank you so much for your insights and sharing some of the insights you get from all of the money shows. That's why I like the shows that you guys put on. It's a wide range of comments, and you can hear bullish, bearish comments on a lot of different sectors, all just playing, whatever direction those markets are going. Thanks again for your time, Mike. We'll chat probably in another few weeks. I hope you have a great rest of your weekend.
Sounds good. Take care, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and we are now shifting our focus to the energy sector as we are chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Also publishes a free report called Eye on Energy, which breaks down more the macro fundamentals in oil and natural gas. As we always do with Josef, we'll start off on the macro front for oil and natural gas and then drive down into some of the stocks and answer some of your questions that you have sent in. Josef, on the oil front, we have seen oil mostly trade sideways, but at least a little upward bias recently. As we're recording this, oil's right around $75 to $76 a barrel. Again, it entered the year in the low 70s, so kind of a slow trade, but at least a little upward bias here. Josef, in terms of key fundamentals on the supply-demand side, anything else that's caught your eye? Take us through some of the key drivers, at least in the near term, for price.
Sure, my pleasure. And I'm glad to be with you again. Crude oil, we had targeted when we sent out our SCR Outlook 2024. We said that we thought in Q1 that we were looking for a range, which would be at the bottom end, 64, 65, and 80 at the higher end. And that seems to be where we see things for Q1. And the reason we're looking for lower prices is right now there's probably $6 to $8 of war premium in because of the Red Sea and the Houthis and the shipping requiring ships to go through the Cape around Africa, and that is adding to costs. We also had cold weather, which shut in a lot of North Dakota production, which is slowly coming back. So we're looking at demand being weaker because of the cold weather and slow economies. We're seeing the UK coming out with recessionary data, as is Germany. We've seen China's stock market implode because of all the weak conditions there and the government trying to find ways to, get the economy back and get people spending. And then, the cold weather we recently had pushed the price up as well. Remember, we had almost blackouts here in Alberta with the warning to cut demand, which people did after they got the warning. And then with help from Saskatchewan, we didn't have any blackouts. But you've seen Texas getting close to blackouts. And then when those really bad days occurred, we had $10 gas prices. But now that we have milder weather, +7 in Calgary, you're looking at prices under $2 again for natural gas. So for oil, I think we're in the next month or two, we could be looking at a break of 70 again. Every time we see it below 70, we're going to add new buy ideas. We right now, from early 2023, we were quite cautious. We only had 5 names. In March, when we had the $65 oil, we added 14 ideas. And then in December, when we busted 70, we added another 7. And then we minused out from takeovers a couple of companies. So the net is we have 25 ideas on the buy list right now. And my expectation is we'll probably add another 5 sometime between now and the end of February as we get pullback below 70. And then we're watching the TSX Energy Index. It's 239 today. We think it'll go below 230. And then the bullish percentage index, another indicator we watch, was 65% 3 weeks ago. It's now 43, and we think it'll get below 10%, which is another buy signal. So we're watching our buy signals, and when we get them, we have a lot of stocks that are cheap. We've introduced 2 new stocks, one in our last issue and one in this coming issue. So we've got a lot of great ideas at bargain prices, trading around PDP, proved developed producing reserves, significantly below 2P reserves, and multiples of 2 and 3 times cash flow. So there's a lot of bargains in both the energy area, the energy service area, pipeline and infrastructure. This is one of the cheapest times that we're going to get. We're not going to get as cheap as March and April of 2020, but relative to other corrections in the sector, I think we're getting into bargain territory. And heading into the end of the year, if I'm right that we go to $90 WTI, and then we start seeing $3 AECO and NYMEX on a regular basis, I think we're going to see the sector have the index go up by 25%. But since the index is heavily weighted to Suncor and the CNQ and Cenovus and Imperial, I think the more exciting growth-focused E&P companies and service companies could see 50% upside from the upcoming lows, which to me is very, very exciting. And as you know, I've been poo-pooing and being cautious for a while, and now I'm getting ready to not only say I'm a buyer, which I've been doing, as our people can see on the SCR buy ownership list that I've been buying regularly when stocks are cheap, but I'm getting close to, if we get this next decline, to saying the sector is a table-pounding buy.
All right, Joseph. So we'll be looking for this next pullback for the table pounding buys, and it's a similar message you had when we did see a low, and then you caught a nice rally in that. So that was a good call last time. So hopefully we see that low, and then if you're looking for $90 WTI and $3 NYMEX and AECO pricing in nat gas, should be a nice run in the energy stocks after a corrective move. But I want to hone in on nat gas. We had talked a little bit before recording, and you've talked on previous shows about the impact that the new liquid natural gas terminals are going to have in Canada and the U.S. I wonder if you could filter that down into how you expect that to affect the natural gas pricing in the market in the U.S. and Canada, because there's a big delta in some of the overseas pricing compared to what we see here domestically. And then how does that affect the nat gas companies? How do they capture some of that spread?
So I think the key is we have to remember that Canada and the west coast of Canada is a much shorter sailing distance between the west coast to Japan, to South Korea, to Vietnam, to China. And so that gives us an advantage over the Gulf Coast, which has to go through the Panama Canal or through the bottom of South America. That adds to the shipping distance and the cost. And if you remember, the Panama Canal has a lot of water problems, so levels are low, so ships can't be fully loaded, which again adds to the cost per unit of sending natural gas through the Panama Canal. So I think we're looking at a big advantage to us once we're up and running. The first LNG plant facility is called LNG Canada. Shell's the one who's the lead behind it with other partners. That'll be at bringing on 2.1 BCF a day. That's on a base of 17 BCF being produced right now in Western Canada, so a nice growth phase. But when you add in that they're planning to do LNG Canada 2, Train 2, and then there's 4 other projects that plan to go up, backed by Enbridge and Pembina and the energy producers, all of that could add another 6-7 BCF, which is a massive growth rate on top of 17, and all of that could happen before the end of the decade. So that means we have a great growth. So let's look at the economics. If the price of natural gas is US 18 to 20 in Asia, and we look at it's $8 or so to liquefy, to ship, and to put out on the other side and give a good return to the owners, then the wellhead price could end up being, for those companies that can contract into the LNG market, they could be looking to $5 to $8 Canadian per MCF. When you have $1 or $1.50 all input costs, you can see that's a good margin versus if you just sell into the domestic market at $3.
So, Joseph, what are the characteristics of the companies that will be able to take advantage of this spread when these facilities are built?
You're going to have to be a company that's either in Northeast BC. ARC is there, and Tourmaline is there, and there's Crew Energy is there, and then there's all the big guys. Sinopec is there, and China, PetroChina is there, Shell is there. So they're going to be putting in their own gas, but many of them don't have enough gas when they go to the second train, so they may need to buy reserves. But the whole process in BC of getting approvals to drill, First Nations, environmental hurdles, people would prefer to drill in Alberta because the processes here are more streamlined. The First Nations are on side more, and we're seeing a lot more activity in Alberta than BC. So I think that we're going to see gas going from northwest Alberta, so Montney, Duvernay gas going by pipe into BC, into the coastal pipeline. And then at the same time, we're going to see strong demand in the Fort Mac area because of the oil sands and SAGD. And then we have the gas that gets shipped to Eastern Canada and also to the U.S. As well. So we're going to see a tightening of supply, and the big supplies that are in storage right now will get drained quickly. That sets up, very high prices for late 24, 25 on, and consistently higher prices. And as more and more of these LNG facilities come on, it just tightens it up even more.
Well, Joseph, we probably get the most questions when it comes to energy around nat gas, even more so than oil. I think most investors are used to the volatility in oil and are trying to play that cycle the way you lined it out, buying on the dips. But with nat gas, it's so volatile. There's a lot of people that wonder if nat gas could get stuck at lower prices because of the huge amount of nat gas produced from oil production. We've had some energy specialists and commodity specialists come on our show and say they don't expect nat gas to do anything because of how much oil production has been coming out of the U.S., out of Canada, and all over the world. Do you think that peak oil production or growing oil production could put a crimp on the nat gas price in any way, or do you think that because of the reasons you just outlined, it'll overcome the excess of nat gas?
The argument is correct right now because we are adding to production in Western Canada because the TMX pipeline is going to take an extra 500,000 or 600,000 BOEs a day, which adds 10% to the production base of Western Canada. Once you have that on, there is no growth unless you're prepared to do rail. So to me, the argument is correct today that there's more natural gas being produced because of the condensate needed to move the heavier barrels and the oil sands barrels, and that is true. But once this new production is on for the TMX and the TMX is producing on a regular basis, then where is the next growth phase? And that's where I disagree with the bears.
So when you're looking at companies that have a split of oil and natural gas production, or just those that are purely natural gas focused, do you like, in a way, the safety or at least diversification that oil and natural gas companies provide, or do you like the potential torque that just a simple, straight natural gas provider could provide?
Well, I like the companies that are oil, that are natural gas with light oil condensate as part of the package, because the condensate is going to be needed, in the Fort Mac and Edmonton area, with all the refineries, with all the new petrochemical plants. There's going to be a big demand domestically for natural gas. So I think the bears are wrong that there's going to be a glut of natural gas. Once the LNG comes on, that argument is gone, because you're taking like 2.1 BCF on day one of LNG Canada up and running. So to me, would they have an argument into late this year, maybe Q1 if something gets delayed for whatever reason, but like TMX has been delayed and delayed and delayed. You never know. But once the LNG Canada is running, I believe their argument is invalid at that point.
Well, Joseph, as far as the actual stocks themselves, between the oil and the nat gas stocks, if you look at ones that are primarily focused on either oil or nat gas, you've said in the past that you were a little more bullish on the nat gas stocks than the oil stocks. It sounds like you're bullish on all of them if we have a big run this year, but which one would you be favoring and why as far as outperformance?
Well, the reason I like natural gas stocks is that, I can see the price of oil going from, let's say, we're right now 75. It could go to 90 to 100 by Q4. And then next year in 2025, you might see $90, $100 pricing. So we're looking at a 50 to 70% increase in the price. Right now, we're sub $2 on natural gas. Once LNG Canada comes on, I think we're looking at $5 and $6 gas, and I think into the end of the decade, we look at 7 or 8. So one, you've got much higher price upside in natural gas than you do in oil. Second, you've got massive volume increases in exports and in demand versus what you would have for oil. So there's a 10% increase coming this year in oil because of TMX, but you've got a 30% plus growth rate in volumes of natural gas into the end of the decade. So I like natural gas stocks. One, many of them are trading at PDP values. And when there's a shortage of natural gas and we have a hot energy stock market, companies trade at 2P proved plus probable reserve values, plus there's something for land and possibles. And we end up getting takeovers at the top of the cycle, as we did in 2008, as we did in 1979, 80, 81, and companies trading at 2P. So you take value today where companies are trading at PDP on low commodity prices. You go from PDP to 1P to 2P, that gives you a big bump up of 3 or 4 times. Then on top of that, you add in the commodity price lift and also new exploration and more volumes coming on. And you're looking at reserve reports that in 2028, 29, that could be 5, 10 times better than they are today.
Wow, that's very bullish heading into the end of this decade in terms of individual natural gas stocks or certain types of those stocks. Are there ones that you've noticed that are lagging or just completely underperforming the broad sector of natural gas stocks?
Oh, I think everything is. If you look at names, you can look at Paramount, you can look at Tourmaline, you can look at, Vermilion, you can look at Crew, you can look at New Vista. There, Pine Cliff, Birchcliff. There's just like the whole list I'm looking at is trading below their book value, below their NAVs, and Tourmaline, the premier company, which is now trading, where's Tourmaline today? $58. It has an NAV of 77. So even the premier company is trading much cheaper. If you go to Tourmaline, it's trading at 25, or Paramount's trading at 25, and it's got a $41 NAV based on 2022 reserves. And you start taking into account the upside. Here's another cheap one, Crew, which is trading in the 4s. 2022 NAV was 1570, and that NAV will go up in the next 4 or 5 years.
Well, Joseph, let's also talk about some of the oil stocks. That was a great list of natural gas stocks for investors to look at in their watch list. But in the oil stocks, are you more interested at this point in 2024 in the dividend-paying larger companies that are more stable and can they keep paying dividends at current prices, and or the smaller, more growth-oriented companies that can maybe drill more wells, grow their production profile, have a nice growth wedge? Which ones animate you more for 2024?
Well, if you look at companies, Whitecap is 66% liquids, and it gives you a dividend of 8%, and they're paying down debt pretty rapidly. That to me looks like a great opportunity for investors. You look at, I'm looking at some of the others with Crescent Point. You got a 5% yield, 76% liquids, and it's trading at a discount, $2-3 from its NAV. You can go to I'm just looking at some of the other oily names just to look at the percentages. Surge Energy, 86% liquids. The company's NAV is 874, and the stock is trading below 6, and it's got a 7.6% dividend yield. So there's lots of opportunities. Bonterra, you've got a 60% liquids. The NAV on Bonterra is 1378, and it trades in the 5s. In-play oil, 57% liquids, and in-play has an NAV of 608, and the stock trades 230. So there's lots of bargains, and in the case of in-play, you're getting a 7.9% dividend yield.
Touching on that dividend aspect, then, are dividends sustainable in your eyes? You sound very bullish on these stocks just from an undervalued standpoint, but are dividends sustainable?
It depends upon their hedge books, and it depends upon their cost structure and the balance sheet. So if you've taken care of your balance sheet and you don't have a problem where you need to borrow to pay the dividend, then you're okay. If you have to borrow to pay the dividend, then you could be in jeopardy, especially with institutional pressure saying don't do that.
You also brought up earlier in this conversation some of the energy services companies. So how would you look at, I know they're a little different, pipeline companies are different than drillers, are different than other tech companies in the energy services, but how are you seeing the overall health of the energy services sector?
Well, the industry in the Q4 and Q1 are going to do very well. They're fully booked in Q1. When I was talking to some of the energy companies, they say to me that Q1 is booked at high prices. The issue is where is the price of natural gas and oil when we get into Q2, and how active a program will people have? The winter program is baked in. Everybody's committed to doing what they're going to do. So the question then comes is, once the winter drilling and we get into breakup, the companies are going to look at their cost structure, and if the price of the commodities is down, they're going to take the 2x4 to the service sector, say, okay, my rig rates, for my rate drilling in the Montney or Duvernay, the price per day has to come down, or you got to throw things in. And in the case of the frackers, there's 2 or 3 new frackers, the DG4s in Canada, which means there's an excess supply. That means somebody could, to keep the rigs working, the equipment working, could lower their price. Service rigs could come down. Steel pipe is already coming down a bit. So we're beginning to see the chance of companies saying that their cost to complete wells is going to come down in Q2, Q3, simply because of the lower activity level and their ability to take the 2x4 to their suppliers.
All right, Joseph, we've been around the energy sector here. Thank you very much for your outlooks, and outlooks not just for this year, even for some areas heading into the end of this decade. We'll see how everything moves here, but hey, look, these companies are still cash flowing quite well, but they just lost some of their momentum to the upside that captured a lot of the market attention a couple years ago. We'll see if they can regain that in an environment now where the broad averages are doing better. So we'll see if that money filters back in, but as you've outlined, higher prices in oil, or especially natural gas, would definitely help that. Joseph, thank you for your time on this weekend show. Everybody, thanks for tuning in. Again, please visit our website, kereport.com, podcast and social media channels, The KE Report, to keep up to date with us and listen to all the daily editorials. Everyone, hope you all have a great rest of your weekend. Thanks for tuning in.